我的朋友你们好不好？今天的 weekly market analysis could be in Chinese. No, I'm just kidding, right? That's not gonna happen because we have people from all over the world, right? The United States, Malaysia, Australia, India, Spain, etc. So nope. Nothing in Chinese. Everything is English, right? So just pull you a fast one. So that's it, right? This week, market analysis, right, is gonna start things off by sharing with you this particular currency pair that could be potentially coming near its end of its 4-year bull market. Alright? And the only thing that is holding it back is just this area of support. If it breaks, I would say things are going to get ugly. Right? Then I'm going to share with you, right, a few things that I look for in a reversal in the markets, right? Because often I get questioned by traders, right, asking me, Rainer, do you think the market has bottomed out? Do you think the market has topped out? And pretty much, right, your guess is good as mine, right? But again, I do look out for a few things, right? Even though it's not 100% correct, but these are the few things that I look out for when before I change my longer term bias of a particular market. So all this and more in this week's market analysis. I'll see you there. Okay, so the first market we are looking at is the dollar yen. This is the weekly time frame, and you can see that it has been in a long-term uptrend, right? You see a series of higher highs and higher lows over the last few years. And what is interesting right now is that it is forming a critical chart pattern, right? This is otherwise known as the head and shoulders pattern. This is the left shoulder, the head, and the right shoulder. And this is what they call the neckline. So what is interesting to me, right, is that there was a fundamental piece of news that came out last week. You look at this daily chart, you see this spike over here, right? This spike occurred because there was news out from the BOJ that they are introducing negative interest rates. So when there is a negative interest rate, people would tend to sell the yen because, who wants to park their money when there is negative interest rate? So they sell the yen, they buy the dollar, and this is why you see this rally over here. So that aside, right, if you look at this week's price action, it's basically horrible, right? Because the 5 days of this week basically reverse all the gains that has been gathered. And in 5 days, right, everything is wiped out and more. So what is this telling you from an investor's sentiment point of view? Right? Fundamentals aside, clearly the fundamentals is bearish for the yen, but the price action is telling you something opposite. So in this scenario, which would you listen to? The fundamentals or the price? And a lot of the times, right, traders make the mistake of following the fundamentals. They say, right, negative interest rate, price, the dollar yen has to trade higher because interest rate is negative. And then they go long and they hold forever. And let's say, what happens is if price, trades lower, they just hold on to their losses and it snowballs until they blow up their account. So that's it, right? When you see this kind of divergence in the market whereby price trades lower when instead it should actually trade higher, it is telling you, right, a clear sign from the market that sentiment is currently bearish for the dollar against the yen. Right? You think about this, right? Such a news, right, couldn't even rally the dollar against the yen. And it's in fact, right, the good news, right, the piece of good news, right, is being reversed by this 5 candles over here, right? All the gains are being erased. So even if such a piece of news couldn't cause it to rally higher, this is telling you that investors' sentiment is bearish on the dollar yen, right? So that's it. What is your plan? Well, I'll share with you what is my plan. My plan as of right now is that I feel that this market would have the potential to trade lower, right? This is my thoughts and what I feel based on the fundamental piece of news and the chart pattern that I'm looking right here. But the market does not care what I feel, right? I don't really care what I feel or what I think. I only trade price. So before I can actually go short on the dollar yen, I need this market to take out one important key level, which is this area of support over here. If this area of support holds, there is no way I'm going to short. But if the price can break and close below this area of support, then right now what is price telling me? It's telling me that my thoughts and opinion on this market could potentially be unfolding itself. And since price has already lit the way, then it makes sense for me to start looking for shorting opportunities, right? So I'm not trading based on the news. I'm not trading this what they call against this uptrend, right? I know what is the background news about, and the background news is sort of giving me a confirmation that there is weakness on this market. But the weakness is not confirmed until this neckline is broken, right? So I let price lead the way. I'm not going to jump the gun prematurely, right? I have patience, I have discipline, and I follow my plan. So that's it. This is my take on the dollar yen. I expect lower prices to come, but hey, I could be wrong, right? It could just reverse back up again. We never know, right? But I'm telling you right now is that if price were to break and close below the neckline, I'll be looking for shorting opportunities. Okay? So with that said, that is my take on the dollar yen. Now let's look at another market, right? The S&P. Again, at this point in time, it's not looking good at all, right? The S&P is basically the 500 listed companies, biggest 500 in the US stock market. So I think a few weeks back, I said there was a bullish sign, right? You see this strong price rejection of lower prices. We had 1 week of higher close, and then this week it closed lower once again. So this is something that does not look good, right? Because if price were to be rejected quickly, it shouldn't, still stay around this area of support. And this week it's approaching back towards the area of support. So that's it. The S&P, to me, the last line of defense is this area of support here. If price breaks and close below it, right, it does not look good at all, right? Especially for the worldwide indices market. So this is my take on the S&P, right? If you look at the other markets, the other, indices around the world, you look at for example, the DAX, right? You zoom out, this is the weekly time frame. You can see, right, it is not looking pretty as well. It's approaching this key area of support. If you look at the Nikkei 225, same story, right? Nikkei 225 is the Japanese stock market, right? It's coming into this key area of support as well. All these indices around the world, they are all approaching the key levels. If it does not hold, honestly, I don't think the equity markets are going to look good. But that's it, right? You're not an investor, you're a trader, and there are opportunities for you to actually, get short once price has confirmed it. So in the meantime, right, you're just basically waiting for price to confirm your so-called, bias. And let's say you look at the STI, the local Singapore stock market, it has already broke out of this swing low over here, right? And what's interesting is that we have seen, rejection of lower prices over here. So there's a possibility of it retracing higher, retesting back the previous support, turn resistance, and then maybe, trading lower once again. So this is the STI. And how about the Hang Seng? Hang Seng, the weekly time frame. Again, pretty similar story as the STI, right? It broke below this key area of support. Price rejection over here, possibly, short term, we could see some rally higher before price reverse once again. So looking at the global stock markets, right, the indices, none of them are looking pretty, right? I don't see any market which is, trending very nicely as well. So I would say, we are in interesting times, right? I can't really predict when it's the recession, but definitely, right, follow price, right? The price will not lie to you. And that's it. Another market that I want to cover today is gold. So a very common question I get is, Rainer, how do I know when the trend is over? All right, how I know when the market has bottomed out? So a lot of people are, speculating that gold, right, has bottomed out at $1,000 an ounce. So again, I follow price. I don't follow anything on fundamentals, right? I don't determine when a market will bottom out just based on fundamentals. Like, for example, crude oil, right? We have, analysts saying that, the cost of production is like, what, $40, $50 a barrel. Price cannot trade below it, because if it trade below it, it does not make any economic sense to, produce more oil. And guess what? We're at $30 today. So that's it, right? Fundamentals can be thrown out the window, right? When, because the market goes where it wants to go. The market goes because there is more buying pressure. The market goes because there is more selling pressure. Fundamental itself is not able to support prices, right? Because we have all sorts of, traders around the world. So what is important ultimately is price itself, right? You don't want to go long on the market just because fundamental is good, but price is trading lower. That is, well, if you're an investor, you could do that. But if you're a trader, it does not make much of a sense. Okay? So that's it, right? This is the chart of gold. And when would I think this price, when gold will actually bottom out? So let me share with you my thoughts. This is the weekly time frame of gold. And this, the blue line here is the 50 period moving average. The red line here is the 20 period moving average. So let me get it down, right? I use EMA, by the way, right? Just my personal preference, and there is no best formula, right? SMA, EMA, or WMA, it doesn't really matter. So looking at the price action context, you notice that gold likes to, do a false breakout on the 50 EMA, and then it trades lower, does another false breakout, then it trades lower, does another false breakout, trades lower, another false breakout, then it trades lower. So at this point in time, right, gold right now has break and close above the 50 period moving average, but it's still too early to say, right, whether it can hold above it. Okay, so for me, right, for me to switch my bias, right, from a long-term bear on gold, price has to do these two things. Number one, I'm taking a reference from this swing high over here. And this black line you see over here is the 200-week period moving average. So two things has to happen. Number one, price has to close above the 200-week period moving average. And number two, it has to break and close above this area of resistance. If it can do that, right, then I will not be a long-term bear on gold, right? Means I will not have a long-term bearish bias on gold. But until then, right, my bias on gold is still towards the downside. But my reference for me, right, to change my bias towards the downside to at least neutral or to be slight bullish is that it has to close above this area of resistance and above the 200-week moving average. And this is it, right? This is my criteria. So that's it, right? In the meantime, right, I don't have any shorting opportunities on gold. Well, you can trade off the weekly time frame, but this is not something I do because the stop loss is just way too large. So what I'll do instead is just, keep a watch list on it, right? See how price reacts, and then just, trade it accordingly if price, reacts according to my favor. So a lot of times traders think that trading is all about predicting, and that couldn't be further from the truth. I can tell you that my trading style is all about waiting, right? Waiting for price to show me its hand, right? I wait for it to break out of a certain key level, then I look to get on board the trade. I don't look to try and predict tops and bottoms, right? Instead, if it starts to trade lower, I look to short. Just like the dollar yen example I shared with you earlier, right? This dollar yen example, we talked about it. Let's go back for a while, right? This dollar yen, right? This is the area I'm looking at, right? If it breaks and closes below it, then I'll look to short. Again, I'm just playing this waiting game. And for gold, I said, right, this is the key level I'm looking for. If you can break above this area of resistance and the 200 period moving average, then I'll start to look for longs. So it's all about waiting game for me, right? I have no intention to predict where price is going to go. I admit that I can be wrong more than half the time, but hey, I'm still profitable because my winners are larger than my losers, right? I always cut my losses as quickly as possible the moment the trade is invalidated. So, and this basically sums up trading for me, right? It is pretty simple, but a lot of traders try to complicate it. Right, they pull up all the fancy indicators, they look at fundamental analysis, they get analysis paralysis, and then they are lost. They don't know what to do. They have so much conflicting information that they can't even execute a trade. So, for example, if you look at this gold chart right now, I can tell you the thoughts of what some trader are thinking right now. Rainer, what about this swing high over here? There is this resistance. Aren't you afraid that price may reverse from here? Or what about this swing high? Or what about this swing high? Or what about this swing high? There are countless swing high on the chart, right? Are you going to wait until price takes out this swing high over here before you decide to get long? By the time, right, who knows, this could be a top and price reverse all the way back down when you decide to get long. I know there are many swing highs on the chart. I know there are, different areas of resistance. But you have to pick one that you're confident of and makes the most sense to you, and tell yourself that, if price breaks above this swing high and this 200-week moving average, I will be looking to get long. Right? And hey, so what if there is this swing high or potential resistance over here? So what if this one is over here? You have your stop loss in place. Right? If you're wrong, you just cut your trade. But what if, right? Just think, what if all these swing highs are basically irrelevant and the bullish strength came in so strong and pushed price all the way back up higher? And you miss the entire move because you think, oh, there's a swing high down here. There are people who are looking to short. You're just paralyzing yourself, right? Just reference it from a swing high that you think makes the most sense to you. That's something that price has not done before over the last few years. And use it as a frame for reference, right? Because those are the ones that you should be looking at. Right, you look at the 200-week moving average. Price has not traded above it since April 2013. Right, in fact, since when? April 2013. That's right. Price has not closed above the 200-week moving average since April 2013. So that is a powerful reference to look at from. Okay, so that's it, right? I hope I don't sound too agitated because it's the Lunar New Year, but I just want to make my point across. So with that, I've come to the end of this week's market analysis, all right? Not too much trading setups because like I've said, right, I'm just waiting, right? Waiting for price to show its head. So that's it, right? I hope you find this week's market analysis useful. If you have any questions, don't hesitate to let me know in the comments section below. With that, I wish you good luck and good trading. I'll talk to you soon.